financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. As you heard, my name is Jerry Robinson. I'm an economist, author of the book Bankruptcy of Our Nation, and the founder here at followthemoney.com, where we help people just like you all around the world learn how to become a better investor, learn how to become a better trader, but without all the hype, right? Without all the hype that typically goes along with it. And talking about hype, today we are going to be talking about crypto. And today, of course, episode number 425, the title of today's broadcast, Is Crypto Dead? Is Crypto Dead? So unless you've been living under a rock, lately, you know that we have seen a really big implosion in the cryptocurrency market, not just in 2022. It's been brutal for stocks. It's been brutal for cryptocurrencies and bonds. I mean, the whole financial market has really suffered. All the different financial markets, not even just here in the United States, but globally, have been under massive pressure, largely due to the rate increases that the Fed is leading. So we're kind of in this time frame where the Fed is no longer providing easy money. No more 0% interest rates, no more easy money. Instead, we have sharp and quick increases in interest rates. And that, of course, is pressuring corporations. It's pressuring profit margins and causing, quite frankly, just a decline in prices across the board. Investors are repricing risk, right, in this new environment where the 10-year yield is 4 or 5%. And actually, right now, the 10-year yield is hanging out around 3.7% as of this recording. Now, that, of course, really changes the equation for a lot of assets and asset prices because the 10-year yield, is the major benchmark for borrowing costs all over the world. And so when that goes up, the cost of money also goes up. And so today, what we're going to be talking about is the recent collapse of FTX, which, if you're not familiar, FTX was, they filed bankruptcy, was a leading cryptocurrency exchange. It was, in fact, the third largest in the world. And so it was a very large and powerful cryptocurrency exchange. And as I mentioned to you, it's imploded over the last couple of weeks, ever since the month of November began. It's really just been bad news throughout the whole month. And what I want to talk about today, in addition to FTX, is the topic of, is crypto dead? Does this mean that the digital asset space, because FTX is imploded, because people are fearful about the safety of their funds in these cryptocurrency exchanges, does that mean that it's the end of the digital asset class? I think that's really what's at stake here. I think people are asking themselves, is this the end of the road? Has this kind of poisoned the well, so to speak, for people to invest in digital assets? So that's really what I want to answer today. And then what I want to do is I want to provide you at the very end of today's podcast, I want to provide you with some of the investing tips that I would give to someone who is still wanting to invest in the digital asset space. And I want to provide those tips to you at the end of today's podcast because I've been investing in the space here now for a decade. I've seen a lot of changes, right? I've lived through a lot of different kinds of scams. I've seen all kinds of scams in the digital asset space. I've seen big institutions. I'm old enough to remember the Mt. Gox collapse. I mean, you got to go way back. I remember the 2013 peak. I remember the Mt. Gox collapse. I remember the DAO hack on Ethereum. I remember BitConnect. I don't know if anybody remembers that. Does anybody remember BitConnect? BitConnect, it got wrecked. I mean, so we've seen this story before, but 2022 has been pretty darn interesting when you think about the crypto space. So let's begin with talking about FTX. So FTX, as I mentioned, was supposed to be acting as a custodian, holding its clients' cryptocurrencies. So with FTX, think of FTX like a Coinbase, where you go and you can buy cryptocurrencies. You can buy Bitcoin, Ethereum, whatever, and then you go and you buy the cryptocurrency from the exchange. Well, many of the exchanges, of course, you can leave them there. Just like when you buy a stock, say on E-Trade or Fidelity, you buy the stock. Well, you don't take the stock and put it in your house. You leave it on the exchange. You leave it with the custodian. And so if you buy a stock, say on E-Trade, well, you buy the stock and it sits in your E-Trade account. E-Trade controls the asset, but you, of course, it's in your name. So the custodian there being E-Trade and you being the one who's buying the stock. Well, it works similarly in the world of cryptocurrency. You would go to Coinbase, or in this case, we're talking about FTX. You would buy the cryptocurrency from FTX. And then what happens is that if you leave it on the exchange, well, then you're kind of at the mercy of this exchange. If the exchange starts doing, pulling all kinds of shenanigans like FTX was doing, then you risk not being able to get your cryptocurrency off of the exchange if they suddenly limit withdrawals, which is exactly what happened in the case of FTX. So FTX was supposed to be acting as a custodian, holding the client's cryptocurrencies when they bought them. If the client decided to leave the cryptocurrency there on the exchange, well, FTX was responsible for protecting it and keeping it. But then what we learned through all this debacle was that FTX, which is owned by Sam Bankman-Fried, he's temporarily, for a time, was one of the richest men in the world. In fact, FTX back in February had a value of $32 billion. Don't know how accurate that is really, but that's what that was the public idea of what the company was worth back in February of 2022. And so now that the company has gone bankrupt, it's really quite something to see that kind of company, that size of a company, just literally, evaporate in the matter of just a couple of weeks. But here's the point: FTX, Sam Bankman-Fried ran the FTX exchange, but then he also ran a sister company called Alameda Research, which was the trading arm, so to speak, of FTX. And what was happening, apparently, allegedly, what's going on here from the filings that we can read, is that the FTX exchange, where they were supposed to be keeping those cryptocurrencies in custody for their clients, in reality, they were taking those cryptocurrencies and they were moving them over to their sister company, Alameda Research, to trade so as to generate cash through market making or through borrowing. And so what you may recall that Sam Bankman-Fried was not only a very big political donor in 2022, but he was also dubbed the quote-unquote savior of the crypto world due to his bailing out of other crypto institutions earlier in the summer, right? So where did that money come from? Well, it turns out that, that was probably customer money, that was being used. So FTX also was using its own cryptocurrency that it issued, FTT, as collateral on its balance sheets. And so once this all came to light, and this came to light, by the way, by a CoinDesk. CoinDesk is a cryptocurrency news website. They kind of broke the story here and shed light on the fact that there was a lot of FTT as collateral on the balance sheet. And this, of course, is bad because the volatility that could exist in FTT could really wreck the company. And so once that really came to light, once that understanding that the company was doing something that didn't look proper, at the beginning, it just looked like something was wrong, but you couldn't quite know what it was until all the filings came out. And once that kind of came to light, FTX experienced a bank run, kind of a modern equivalent of a bank run in the crypto world. And people rushed to liquidate their holdings, their positions, get their money back. And then, of course, FTX, once customers on November 6th, by the way, they had withdrew like $5 billion. I mean, that was a massive bank run. And again, not a bank. FTX is not a bank. It was acting like a bank, but it wasn't a bank. But and we'll talk about that in just a minute. But $5 billion with a B that came out in one day on November 6th. So that automatically led to the insolvency of FTX. They halted customer withdrawals since they didn't have any crypto to honor all of these, withdrawal requests. And so they entered into failed talks with Binance. That's Binance, one of the largest cryptocurrency exchanges on the planet. And Binance looked at the books and then changed their mind. They said, no, we're not going to buy, FTX. So it turned out that the company was somewhere between $8 and $10 billion short of being able to honor the withdrawal requests. They also had some sort of strange hacking that went on right around the same time, which another $500 million was lost, supposedly. And then, of course, the company on November 11th, they just decided to file Chapter 11 bankruptcy. They didn't have a choice, right? So that was quite a mighty fall for a company that was valued at $32 billion back in February of this year. It's really crazy. Now, what is interesting about all of this, I think, is that FTX was operating like a bank. It was actually doing what banks do, probably in a different fashion, of course, but quite frankly, very similar. If you've read our book, Bankruptcy of Our Nation, I talk about in the book the fractional reserve banking system that we have in the U.S. banking system. All Western banks pretty much use it, but it's fractional reserve banking, and that is where when you go into a bank, say Bank of America or any bank, and you make a deposit into your account, say $100, well, the money that you've placed on deposit there, only a part of that has to be held in reserve. They call that the reserve requirements or the reserve requirement ratio that, banks are required to hold. And the Federal Reserve, kind of makes these rules. And so the fact is that, when you make a deposit down at the local bank, if you put $100 in, well, $90 of that or so can be lent out to somebody else, right? So banks do this. The problem is that FTX is not a bank, and it was acting like a bank, and it didn't have, FDIC insurance like a bank does. So it didn't have any of the investor protections that typically go with it, right? But the problem is that people were promoting these exchanges as if they were banks, as if they were safe, and the truth of the matter is it just wasn't. It just wasn't safe at all. And this kind of drives you to the question, at least for me, I think to myself, when are we ever going to learn? Are we ever going to learn what Bitcoin really is? I mean, if we understood what Bitcoin was, then we would not be falling for these problems consistently, especially when it comes to exchanges. Over the last decade, as I mentioned to you, I've seen all kinds of scams, and I've been scammed. I mean, you can't be in the digital asset space and not get scammed. I mean, I just don't think it's possible, especially being in it for more than 10 years like I have. I've seen all kinds of things. Now, fortunately, the scams that I've been caught up in have been very small, very, very small. I mean, in other words, I put in small amounts of money into these things. So like back earlier, I think it was last year, or maybe it was, 2021, Celsius came along. And so I said, hey, I told our members, hey, I'm going to put a little bit of money into Celsius to see what it's all about. I'm going to kick the tires and see if it works, right? Because some people were saying, hey, is this a good idea? I don't know. I'm not really sure. So, but we typically teach our members to keep your cryptocurrency offline, off the exchanges, not on the exchanges. But whenever you have some of these attractive offers, I decided to put a little money at risk just to see, as a test for the benefit of our members. Guess what happened to Celsius? It dried up. What withdrawals were stopped, and then the thing went bankrupt, right? I did a little bit of money also into BlockFi, very small amount. BlockFi, you may have heard recently, was closing down customer withdrawals. I mean, same thing here, right? Fortunately, we got our money out of BlockFi before that happened. We didn't in Celsius, so we lost a little bit of money in Celsius. But we're learning as we go, and fortunately, our members were able to benefit from our lessons as we were learning in real time. So we've seen this happen. We've seen this happen, and the whole point, as I bring up with Bitcoin, is this latest FTX scandal really just reveals how much the investment community misunderstands the fundamental value proposition put forth by Bitcoin. I mean, the whole point of Bitcoin was to enable people to be their own bank through self-custody, right? Where you don't have to rely upon a third-party intermediary. I mean, Bitcoin, as we've been teaching our members now for over a decade, it's incredible. Well, I'm thinking back at even some of the Follow the Money summits we did. We brought Trace Mayer along, where he would talk about Bitcoin. I would talk about Bitcoin. We were explaining to people, look, get this on a hardware wallet, run your own node, whatever you got to do. But what's amazing about Bitcoin is the fact that it offers a transparent means of value transfer without the need for a third-party intermediary, okay? So there's no banks required. There's no financial institutions required for interfacing, transacting, or using Bitcoin. That's the primary benefit of Bitcoin. I mean, there's other benefits, of course, but that's really kind of the big value proposition, the unique value proposition that Bitcoin brings to the table is the fact that it eliminates the need for trust. It eliminates the need for a trusted intermediary. And that has revolutionized the definition of money, whether people like to admit it or not. And that explains why global banking giants like Citigroup and MasterCard and Wells Fargo are launching a 12-week U.S. digital dollar pilot program with the Federal Reserve Bank of New York. That was a report that was just put out by Reuters just a few days ago. We've been talking about the coming digital dollar. So the Fed realizes the power of what the unique value proposition of Bitcoin is, and it is running to create something that provides something of a challenge to Bitcoin. So and this is really something that we have to watch. Oh, in fact, by the way, speaking of the dollar, we tackled the topic of a digital dollar back in episode number 405. If you're interested in learning more about our take on that, we have a podcast called Get Ready for the Digital Dollar. That was 20 episodes ago. But we are, as I stated, we are in a place now where everyone really understands the fact that digital assets are here to stay. I think they fundamentally misunderstand what their value is. We are, as we look around, we see, of course, we're in a bear market. We see that the bear markets have a way of exposing the over-leveraged. We've been in a bear market now with crypto for some time. 2022, as I mentioned, has been brutal. And we've lived through these things. I told you about Mt. Gox. If you were investing in Bitcoin when we were way back in the day, a decade ago, well, Mt. Gox would have been, the scandal of the day. I mentioned BitConnect, that got wrecked. Then you had Terra Luna, which was not an exchange, but it was actually a cryptocurrency that if we had read the white paper a little closer, we would have seen that this was a problem. So this, of course, points to the fact that you should never invest more than you can afford to lose, right, when it comes to cryptocurrencies. And many people did. They got over-leveraged in things like Terra Luna, which, imploded earlier this year. You had Three Arrows Capital, which also 3AC, which also had a tremendous amount of exposure to bad things. Celsius got caught, right? The lesson learned there was self-custody. Keep your crypto on your own hardware wallet. Keep it in cold storage. Don't put your crypto on the exchanges, right? This is what we're learning over and over and over the hard way, right? So Celsius got caught. Voyager got caught. You may remember them, Voyager Digital Assets. They were backed by Mark Cuban. The lesson learned there, self-custody, right? Keep your cryptocurrency in your hardware wallet. Keep it offline. Keep it off the exchanges. BlockFi got caught. Again, the lesson learned here is self-custody. Keep the custody of your Bitcoin to yourself. Keep it on your own hardware wallet. FTX imploded. this month. Again, the lesson remains the same. So we've had smart contract hacks. We've had rug pulls. These are all part of investing in the Wild West of crypto. But, one of the things that people fundamentally seem to miss about all of this is the fact that if you read the white paper on Bitcoin, what it does, as I stated, is it allows people to transfer value without the need for a third-party intermediary. You don't need a trusted party in between. It's a trustless kind of setup. And what's so strange is that we would take the Bitcoin that was created by Satoshi Nakamoto, and we would take the Bitcoin and we would say, okay, we're going to buy some Bitcoin, and then, which doesn't require any financial institution for me to find value in this. And then what I'm going to do is I'm going to give it to financial institutions. I'm going to give my Bitcoin to financial institutions. This defeats the whole purpose of what Bitcoin is. You don't give it to a third party intermediary and give them control of it. That's what we're not learning here. We're not learning this. So, yes, I have over the years learned that lesson with a little bit of money the hard way, and that's why we teach hardware wallet, cold storage. Right? We've learned through small little tests along the way that these exchanges cannot be trusted. So if you put your money into cryptocurrency and then you just leave it on the exchange, you're asking for it. You really are asking for it. We have evidence of this from the little bit of money, the little bit that we've put at risk on these exchanges. We've seen it, right? So that's why we keep the lion's share of our crypto, in fact, all of it now, off of the exchanges, right? So we don't even mess around anymore with any of the exchanges, even though we did as tests for a period of time. And I got to say, by the way, I've long been a student of economic history, monetary history, et cetera. And I have to say that today's digital asset market in the U.S. reminds me of the days of the bucket shops in the early 1900s, all in the pre-1930s, or all before the 1930s regulations came along that were shaped in the wake of the Great Depression. The bucket shops were where Jesse Livermore, guys like Jesse Livermore, began to make his living. In fact, he got kicked out of bucket shops all around the country because he would make too much money. But bucket shops were a way to speculate on rising stock prices without ever owning the stocks themselves. It was a unusual kind of setup, at least from our modern perspective, because it was a pre-regulation era, and that's where we are now with cryptos. We have Washington still sitting on its hands, still can't make up its mind on how it's going to regulate crypto, and we're not against cryptocurrency regulations. We actually think that's probably the best way forward. That's how you'll legitimize this asset class for institutions. That's how you can make rules, and no matter what kind of regulations they make, they won't be able to prevent people from taking the Bitcoin and keeping it off of exchanges. So no matter what kind of regulation they have, they can't prevent you, literally, physically, they can't prevent you from keeping it in a hardware wallet, keeping it offline, keeping it in cold storage. So bring the regulation. In fact, we need regulation. There's a chance they may over-regulate. There's always that concern. But at the same time, regulation is needed to legitimize the industry in the eyes of corporations and institutional investors. That won't affect me at all or you at all if you just want to invest in Bitcoin or Ethereum and hold it on your hardware wallet, right? So I think that's a good thing. And obviously some lessons here. Don't give your Bitcoin to financial institutions. Right? Just don't do it. It's just not, keep that to yourself. And I know it's harder than just simply leaving it on the exchange. It's the way people tend to think. But that's how they think about stocks. They buy the stock and they don't put the stock on a hardware wallet. That would be ridiculous. So they just keep it on the exchange, E-Trade or Fidelity, whatever their brokerage account is. But cryptos, you have to be more diligent. You realize there's not that FDIC backing you up. There is no SIPC. There are no alphabet soups behind all of these things ready to bail you out if the company goes south. So it's just very important to keep that in mind. Now, we've kind of laid out the FTX implosion. We've kind of provided some historical background for it. What I want to do now in the closing moments of our podcast is I want to do two things. First, I want to give you some tips on how you can continue to invest in digital assets without risking all of your digital assets because some exchange implodes, right? So I want to give you some tips that I have learned over the last decade as a digital asset investor. And then I also want to provide you with a forecast of what I see coming forward as far as prices and how long this crypto winter may last. But let's just immediately crush the idea that crypto is dead. Crypto is not dead. What has happened here has been a scare. What has happened here has been a really bad, brutal Ponzi scheme, it looks like. But that itself, it is not a hack of Bitcoin. Bitcoin was not hacked here. Bitcoin was not compromised here. Ethereum was not compromised here. Some of the greatest digital assets that are out there, these great projects, they weren't compromised. What happened was that a bad actor or a set of bad actors stole people's crypto. They stole them, right? They straight up stole them. How did they steal them? Because people voluntarily gave their crypto private keys to a financial institution that was not regulated in the way that other types of financial institutions are regulated. So because of that, and because there was no real meaningful protection for investors, it has caused a black eye on the cryptocurrency market. But this is not going to keep digital asset investors away from the market forever, but it will probably temporarily, right? And that actually bodes well for us because the scare tends to drive down prices. And I suspect that the crypto winter could reach its bottom sometime in the next couple of months. When you go back and you look at how Bitcoin has reacted to its halving cycle, we're currently about 500 days away, a little more, from the next Bitcoin halving. And if you're not familiar with that, we've done videos on that for our members, and we've even talked about that on this podcast. But in essence, it's where the Bitcoin miner's reward gets cut in half every 4 years. And because that Bitcoin miner's reward gets cut in half, well, that's the inflation rate. That's the scheduled inflation rate. So when the halving occurs, the inflation rate goes down. So less and less and less every 4 years, new Bitcoin's coming online and made available. So as institutional demand for things like Bitcoin rises, well, you have a deceleration of the inflation rate of Bitcoin. So it's kind of like the perfect marriage of declining supply and rising demand. So we expect that all of that still bodes very bullish for digital asset investors, especially those focused upon, the really meaningful cryptocurrency projects like Bitcoin and Ethereum. Corporate adoption, by the way, of blockchain technology and the corporate investment into the digital asset space has been off the charts in 2022. So while many people are looking at FTX and assuming that means that it's the death of the crypto market, in reality, Fortune 500 companies have been going all in on blockchain because they know that this digital asset space is not going away. Yes, it has a black eye because of FTX. Yes, people are scared right now and there's fear in the crypto market because bad actors like Sam Bankman-Fried apparently, and I hate to call him a bad actor. I don't know the guy. I don't know what his intentions were. It's all alleged right now. So, but clearly, there was some bad faith here. I mean, there was something wrong. And so it's a bad deal. But that obviously is not going to destroy the whole digital asset space, just as Lehman Brothers collapsing back in 2008 or any of the other, or the Bernie Madoff scandal or whatever. All of these things didn't lead to the destruction of the financial markets, but they caused a period of time where people really kind of smartened up. And that's my hope here, is that people will smarten up, right? People will smarten up. And we don't see any kind of slowing down from corporate adoption of blockchain technology, right? The smart money usually waits for the busts to invest heavily into a space. And that's what we've seen in 2022. You got MasterCard, you got Visa coming in full steam ahead into the blockchain space. Google, Apple, go down the list, Amazon, they're all in on the blockchain space. And so the idea that that FTX is somehow going to stop all of the corporate adoption and the move towards a digital asset infrastructure, and that's going to stop people from investing in cryptos in their 401ks, and it's going to stop people investing in Bitcoin for the long term. It's absurd. But it does provide a very good opportunity for those of us who are long-term investors in the space to be able to acquire more with our investment dollars. And that's really what I like about this whole situation. That's the silver lining. I mean, obviously there's nothing much to like here about any of this, but there is some silver lining. And the silver lining is the fact that we have seen a pretty sharp pullback in many cryptocurrencies, in addition to what we already had in a 2022 bear market, right? So in summary, we do not believe that the cryptocurrency market is dead. We do not believe that Fortune 500 companies are going to stop building out their blockchain infrastructure. We do not believe that institutional investor demand for digital assets is going to go down instead of up over the next many years. We believe that we are still on a good path for corporate adoption, institutional investor adoption of the digital asset class space. We also expect in the next 5 to 10 years to see financial advisors aggressively telling their customers to invest anywhere between 5 and 10% into the digital asset space, because customers will be wanting that. They're already showing signs that they want that. So this is a new assets class, and it's here to stay. Even though you have bad actors in the space, you had the same thing in the early stock market Wild West, right? Just because there were a bunch of bad actors pre-1933 in the United States in the stock market doesn't mean that the stocks were just sworn off. Well, we can't do stocks anymore because there were some bad guys. No, that's not how it works. So we're not going to see the digital asset space go away, even with regulation. Even when they bring regulation, we don't expect the crypto market to crumble and go away. That's not what we are expecting whatsoever. What we see, though, is a near-term hit, black eye, that's going to stay there for a bit. And so we're expecting to see the crypto winter probably last for another month or two. It could consolidate for a while. And if I had to make a prognostication or a forecast as to, because we did get a lot of questions of when do we think that the market is going to rebound? When do we think we're going to start seeing the market go back up when it comes to Bitcoin and Ethereum and some of these digital assets? When are we going to really see the bull market return? What I would say to you is that I expect that we are probably going to begin to see the thaw of this crypto winter begin as early as April of next year. And what I mean by that is that we could see a bottom between now and April. I suspect that bottom, if we haven't already seen it, to be sometime possibly in December. And then as we move into April of next year, I would suspect that we will begin to gently start rising again. So probably it'll coincide with the actual spring. We'll actually begin to see a crypto spring, so to speak, instead of this brutal crypto winter we've been in. It'll probably coincide with the actual physical spring on Earth, starting here in the, at least in the northern hemisphere. So we expect to see the crypto markets begin to thaw and begin to rise by April. Remember, by April of next year, how many people are really going to remember FTX? Now, they don't even remember, some of the scams from just a few months ago. So sadly, they're probably going to forget all the lessons that they should learn. That's what people just do. That's what's sad, right? But for you who are listening to this podcast, I want to leave you with 4 tips learned over the course of 10 years of investing in digital assets. Listen, there's a bunch of scammers online. You can go on YouTube, you can go on Facebook, you can go on TikTok, you can go on Twitter, and you can find all kinds of influencers out there telling you should do this with your money. You should do that. Let's go all in on this together. Everybody should buy this. This is what I recommend. It's going to go to the moon. Okay, you can go listen to all of that. There were major influencers who were telling you to put your money on FTX because it couldn't lose. They were telling you to put your money in ththese things. Now, that's just straight up dangerous if you don't provide all kinds of caveats around it, because there's a lot of danger here, right? If you're good, as we've already laid out. So you can go listen to all of that. You can go listen and ingest all of that kind of information from most of these people who haven't even been investing in the space very long. They're just, out there, they have a big following somehow, and then they start just talking about what they think, and they don't have any skin in the game, or if they do, they haven't been doing it very long. not bragging here, but I mean, we've been investing in the space for 10 years, right? And we don't go out and do a bunch of clickbait to drive people to our podcast or to our website and try to, to do what we've seen some of the, I'd like to see the end of some of these influencers, quite frankly. I've seen them harm so many people. And many of the people who come to follow the money have been harmed by some of these influencers out there that are, pushing all kinds of crazy stuff, right? Not just crypto. They're pushing penny stocks and, all kinds of trash. But oftentimes they get paid to do it. So that's a problem. Now, what I want to do is I want to leave you, as I mentioned, with 4 simple tips from our own cryptocurrency investment approach that will help you, I believe, those of you who want to make this emerging asset class part of your own long-term portfolio. Number 1, this is what we've been doing since 2013. We invest a nickel out of every investable dollar into digital assets, right? So because the digital asset space is risky, we've always considered that the money that we put into cryptos to be potentially lost, right? Therefore, we intentionally limit the amount of money we put into crypto. Every week, we set aside 5% of our investable dollars exclusively for investing into our favorite cryptocurrency projects. So by dollar cost averaging in once a week, then we are able to buy more when prices are low, and we're able to buy less when prices are elevated. The large majority of our weekly crypto investment goes into Bitcoin, right? A lesser amount goes into other cryptocurrencies that we have researched and that we dollar cost average into as well. So the first tip is basically don't invest more than you can afford to lose. To us, that's a nickel out of every investable dollar. Somebody might say, wow, you invest in digital currencies, you're probably going to be living under a bridge, if something goes wrong. No, a nickel out of every dollar. Hopefully you heard what I said. A nickel out of every dollar. A nickel out of every 5 cents out of every investable dollar. That means 95 cents of every dollar that I can invest is not going into cryptocurrency. And it's been that way since 2013. So we just continually put a nickel out of every investable dollar. See, I like real estate. So the lion's share of my investment dollars go to real estate. That's the way it normally is. But a nickel goes into crypto. And you say, well, that's not very much. It's not going to really add up. Well, it does over time. If you do a nickel, every week or every month or every so often, then it's going to build up over time, right? And that's really the goal. So you don't have to go all in to invest in digital assets. And that's why many people, because they don't understand allocation, they're like, well, I can't invest in digital assets because that would be too risky. Well, with a nickel of every dollar, I don't know how that's uber risky. I mean, you still have 95 cents of your investing dollar. And if you're investing in things like Bitcoin or Ethereum, those things, haven't gone away. They haven't been hacked. So thinking in those terms, I think is helpful, right? Allocation is really what we're talking about here. So number 1, don't invest more than you can afford to lose. For us, we put a nickel out of every investment dollar into digital assets, and that's what we do. So the number 2 idea here is to have a long-term investment horizon. Right. So you can trade cryptos. And I think trading cryptos is probably one of the very best assets to trade because of the volatility that's so volatile. But we believe that the digital asset space is here to stay. And therefore, we're interested in investing in the best of the best with a long-term mindset. And quite frankly, given our time horizon, we actually prefer lower prices to higher prices as it allows us to accumulate more. Put simply, our nickel buys more cryptocurrency each week when prices are low than when they're high. So if you're a long-term investor, what do you want? Higher prices or lower prices now? Now you want lower prices. Later you want higher prices when you go to sell, right? Ideally, that's the best idea, best way it could work out for you. But ideally, if you're dollar cost averaging, you want prices to be lower. So therefore, as a dollar cost investor into the digital asset space, I'm like, bring the crashes now. Let it come down. I'm happy to be able to buy more when prices are down now, right? And remember, all these things will pass. So a long-term investment horizon really beats trying to time the market with your investments, right? It's better. Now, of course, trading is a different story. You can certainly use market timing tools to trade. That makes total sense. But for investing, if you're a long-term investor, you really just want a dollar cost average. That's our strategy. Number 3, so we're going through our top 4 tips here. Number one, I said what? We don't invest more than we can afford to lose. That for us, that's a nickel out of every dollar. Okay, there you go. So that way you can invest in digital assets without risking the farm, right? Number two, we said we have a long-term time horizon. That's how we approach this investment. Number three, this is really important for what we've just been talking about, FTX and all the implosions of the exchanges. Number three tip, we keep our crypto holdings in cold storage at all times whenever possible, right? And usually it's possible. So, this really caught people's attention earlier this year when Coinbase revealed in its latest earnings report that user funds could be in jeopardy if the company ever declared bankruptcy. That caused people to say, wait, why am I leaving this money, these digital assets on Coinbase? Maybe I should take them out and put them in my own hardware wallet. Agreed. This has been our message now for a full decade. We've been talking about Bitcoin. We've been talking about digital assets. And we've said self-custody is the key. Basically using a hardware wallet. It kind of reminds us of the old adage, not your keys, not your crypto, right? Self-custody is key. It's using a hardware wallet may seem like a hassle, but it's vital to securing your portfolio from all manner of risks. Cold storage, offline, away from the internet, right? We hold our cryptocurrency in our own possession, i.e. our private keys, on a hardware wallet for the same reason that we own physical gold in our possession instead of in an ETF. But as I mentioned, cold storage comes more personal responsibility for your assets, and you need to understand cold storage, how that all works. And we choose to store our crypto holdings on hardware wallets like Ledger and Trezor. We've a ton of resources for our members here on the cryptocurrency space. We've been doing it for a decade now, so we have a lot to share with our members on that topic. The fourth tip is to earn staking rewards with your cryptocurrencies while leaving them in cold storage. So not all cryptocurrencies pay staking rewards, but some do, like Ethereum, for example, or Cardano. And so what we do is we like to keep our cryptocurrencies in cold storage instead of on an exchange or a lending platform, and then earn staking rewards from the cold storage. And that's possible. And we have an in-depth video tutorial on our crypto staking approach on our website. Many of our members have reported how helpful this has been, teaching them how they can stake their cryptocurrencies without having to take them off their hardware wallet. We help our members understand how to do this, and it provides the ability to keep your cryptos off the exchanges, still earn those staking rewards, but not face the kinds of problems that people who had money in FTX or Celsius or BlockFi or even Genesis. This morning, I'm seeing a headline, Genesis Trading suspends redemptions and new loans in wake of FTX. I don't know how much this is going to spread. I do know that FTX apparently had, according to the latest bankruptcy filing, perhaps more than 1 million creditors. Genesis is one of the largest crypto lending institutions, and there could be more contagion, right? There could be more. Absolutely. We may not have seen the end of this. In fact, we probably haven't. But the idea, of course, is that the way you can protect yourself, at least from that risk, is to not have your cryptocurrency on exchanges, right? So don't invest more crypto than you can afford to lose. Adopt a long-term dollar cost average approach with a long-term time horizon is our suggestion. Hold your private keys, i.e. get your crypto off of the exchanges and earn staking rewards when possible right there on your hardware wallet. And also just maybe kind of a bonus tip is just keep learning from your mistakes of your own and others. I've made mistakes along the way. I could kick myself for some of the things I've done with stocks over the years. I traded my first stock back in '96. I made some dumb moves, over the years. I mean, it's how it is. I've been trading for 25 years. Of course, you're going to make dumb mistakes. I traded my first option in 2002. I made dumb option moves, and then I bought my first cryptocurrency more than a decade ago. I've made my handful of mistakes. Everybody's going to. Don't kick yourself if you made a mistake. It's okay if you've made a mistake. The point is to keep learning from your mistakes, right? That's all you can really do. That's all you can really do. Just keep learning from your mistakes. So in summary, is crypto dead? No, crypto is not dead. The digital asset space has a big black eye, and it is in desperate need of common sense regulation from Washington. We are very likely going to get that. But for you and I, people like you and I who want to invest in the space, we already have all the tools that we need. We can buy the cryptocurrency through exchanges. We can then get that cryptocurrency immediately off of the exchange and put it into cold storage. That way there's no exchange risk. There's no exchange risk whatsoever. All we have then is just sheerly the risk that the cryptocurrency may fail. But no one will then have our cryptocurrency. No one will hold our private keys. So that risk is eliminated. Crypto is not dead. People are just waking up to realizing what the real problem is. And hopefully the solutions we put forward will help you avoid some of that mess as we go forward into a very uncertain future. Hey friends, Jerry Robinson here from Follow the Money Radio. Are you interested in trading or investing in cryptocurrencies? If so, you should know about our new leaderboard service for cryptocurrency investors and traders that we have here at Follow the Money. We launched it at the beginning of 2022, and the crypto leaderboard is designed specifically for those who want to stay laser focused upon the hottest crypto markets right now. Each weekend, every single Friday, our members who receive the crypto leaderboard receive our crypto report as well as our crypto leaderboard. Now, the crypto report is jam-packed with charts and insights on cryptocurrencies from myself, and we also provide the crypto leaderboard, which is a list of the top 60 of the largest cryptocurrencies ranked in their trend ranking. So basically, whichever cryptocurrency is leading at the moment based upon momentum and trend strength, they are at the top. So this keeps you focused upon the hottest markets right now in the cryptocurrency market. And right now, of course, the cryptocurrency market is in a winter, it's in a slump. So many prices are down. But as we move into the next bull market for cryptocurrencies, this service is going to be something very valuable to many of you. It's already been valuable in this bear market we've been in all throughout 2022, with our crypto leaderboard outperforming the performance of Bitcoin itself. This package contains everything you need to stay focused upon the top trending cryptocurrencies each and every weekend. You can unlock access now for one low price for the entire year. This powerful crypto package comes with our gold and platinum memberships. However, it's also available as a standalone service. You can learn all about this powerful investing and trading service by going to our website, followthemoney.com/cryptocurrency. That's followthemoney.com/cryptocurrency. All right, friends, welcome back to the final moments here of today's broadcast. I hope you've really enjoyed this helpful podcast episode on the topic of cryptocurrency. It's a wild time right now, but I want to encourage you to dig deeper. If you found this podcast episode to be interesting and even appealing, and you want to learn more about our cryptocurrency investing approach, I encourage you to check out our memberships. Gold and platinum members here have access to our entire cryptocurrency video archive library. They have access to our cryptocurrency portfolio. They have access to our cryptocurrency leaderboard and report that goes out every single weekend. Lots of crypto resources, not just stocks, not just ETFs, not just commodities, but also cryptos here. And so if you're interested, be sure to become a member here. Followthemoney.com/join. Gold and platinum members get access to all the cryptocurrency information that we put out. And as always, I like to leave you with a final word, this time taken from the book of Proverbs, chapter 21, verse 5, when it says, "The plans of the diligent lead surely to plenty, but those of everyone who is hasty surely to poverty." A warning here on haste and being hasty. Reminds me also of Proverbs 10, verse 4, which says, "Idle hands make one poor, but diligent hands bring wealth." Don't wait for opportunity to come to you. You have to go and make it happen. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.